Welcome. Thank you for joining us for today's webinar. My name is Tony Caswell. I'm a senior marketing manager for the energy refined fuels business at DTN. Today's webinar is titled Navigating the Renewable Diesel Gulf Coast Market Supply, Demand, and Pricing Strategies, and it is presented by Argus. Just a little housekeeping before we get started. This webinar is being recorded, and a link to the recording will be provided to all attendees in the next day or two. If you do have any questions during the presentation, please type them into the Q&A tool in your WebEx control panel. And if time allows, we will address your questions when the presentation is complete. Now, let's meet the presenters. Today, you'll be hearing from three biofuels experts from Argus. Jasmine Davis, an associate editor with Argus Media. She's joined by Andy Schwartz, an editor with Argus Media, as well as Leah Kennan, senior manager, energy transition and biofuels for consulting. And with that, now I'll hand it over to Jasmine to get us started.
Good morning. I'm Jasmine Davis, and I head up U.S. renewable diesel coverage for our America's Biofuels report. I'll be your main presenter today, as Tony said, and I'm going to be covering current events and a broad look at the supply balance for the California renewable diesel market. It looks like we've got a few compliance slides to get through, so bear with us for a few seconds. All right, and then this is our view of Argus. What I'll say here is the markets we're discussing today, we not only assess them in the Americas, but we also do have a pretty strong global representation. And for more on that, you can check our website. And we can go forward a slide or two. Perfect. All right, so today we're going to take a pretty broad view of the US renewable diesel market. We're going to start with a refresher on current events, supply and trade dynamics affecting the California market this fall, factors that are probably going to persist through the end of the year. We'll zoom in on the particular supply flows, both rail and waterborne product to the US West Coast, as well as scattered exports from the US Gulf Coast. We'll dive a touch further into the overall supply balance with a quick discussion on estimated US production and California's ever volatile split between conventional in-state carb diesel versus other diesel grades. Looking ahead, impending changes to both US and California specific policy are poised to be key drivers of price and supply trends moving into 2025. We'll touch on expectations and the present timeline for those changes. And then lastly, Andy will lead us out with a brief introduction to our coverage of R99 at both the US Gulf Coast and now the New York Harbor. Getting started with those recent price and supply trends. So it might go without saying that it's been a quieter season for spot R99 price movement in California. We could easily spend the rest of our allotted time diving into causes for this, but it mainly boils down to uncertainty and supply tightness, with the former often the driver of the latter. Progressively tighter spot availability at the heads of the pipeline, or HOP, from this point forward has limited liquidity in two key California markets that we monitor. That's going to be Los Angeles and San Francisco. Reduced availability has encouraged suppliers to earmark most volume for their existing contracts, usually at the expense of their ability or willingness to engage in those spot HOP markets. Fewer offers have meant higher values when sellers do engage, but overall, there's been a limit to liquidity. In October, we heard on multiple occasions speculation that there was just one seller who was engaging and offering spot HOP volume in Los Angeles, and the differentials for that volume were discussed very broadly, from a 9-cent discount to our carb complex pricing basis to a 20-cent premium to that same basis. And when we say carb complex, we're talking about the regional carb diesel value plus attributes, and I'll get further into those attributes in a minute. Those higher differentials in turn, oh, we're still on the back slide, sorry.
Oh, sorry.
Those higher differentials in turn boosted our published cash prices from Argus series lows reached in the third quarter of this year. Longer term supply uncertainty regarding both domestic and foreign produced product makes near term relief for that supply strain less likely, while production hiccups, most notably ongoing at Neste's Singapore biorefinery, have exacerbated outlooks for tighter availability through the end of 2024 and moving into early 2025. Anticipated US policy changes were already expected to stymie the flow of imported RD to the US West Coast into the new year. But the initial expectation was also that importers would take advantage of the remaining time on the BTC and really front load those deliveries to the West Coast this quarter. Altogether, this presents a current and probably longer term supply landscape, really unencouraging of risk for the spot market. And now we can go ahead. So here's a closer look at those price trends and a reminder here that our hop differential is against the regional carb diesel price plus attributes. Those attributes are the CCA cost for diesel, the LCFS cost for diesel, and the crude CI deficit cost for diesel. And you can find more information about our methodology for these prices in the Argus America's Biofuels methodology on our website. With that in mind, an uptick in the differential on the left won't and clearly doesn't necessarily correspond with an uptick in outright cash prices for spot volume in the head of the pipeline market. We also have to look at the role of credits and, of course, those underlying carb diesel markets in LA and San Francisco, which, of course, are underpinned by the prompt NYMEX ULSD contracts. We can go ahead. And those carb ULSD markets are volatile. Renewable diesel is capturing progressively a larger share of the overall California diesel market, really limiting the liquidity of those spot carb diesel markets upon which renewable diesel prices are often tied. Volatility and lower prices also contributes to a lack of supply stability in the state's overall California diesel pool. And we see this reflected in fairly large swings between the production of carb diesel versus other diesel grades each week. And for that, we're looking at the California Energy Commission data and that other diesel fuels category. While it includes renewable diesel, it does also include high sulfur and the export grade of California diesel, which is EPA diesel. Combined diesel stocks did hit a record low of 2.2 million barrels in late May. And again, that's including renewable diesel per the CEC. We can go forward. So we've covered the latest in spot pricing, but what about the actual flow of renewable diesel into California? Renewable diesel imports have continued to trend higher as California's market develops and consumption proliferates to other regions. True offshore imports to the US averaged an estimated 1 million barrels per month from January to September of this year. That volume's mostly coming from Singapore, although we do see the introduction of volumes from Newfoundland in roughly the second half of 2024. That's the green bar on the chart we're currently looking at, and it represents deliveries from Brea's Come By Chance refinery. Notably, we did have some pretty big months for RD arrivals this summer. July's estimated 1.4 million barrels is the highest we've seen. And then one housekeeping item here, only deliveries confirmed via bill of lading are represented on this chart. So that lower total volume for October should increase as those remaining expected cargoes are confirmed and we receive those bills of lading. And for context, we anticipate about 716,000 barrels of imported RD for October, plus a nearly equivalent volume of Jones Act deliveries to the West Coast from the US Gulf. And we're going to look at those Jones Act deliveries a bit closer in just a few minutes, but we are looking at vessel movement data from the trade and analytics firm Kepler when we talk about those vessels. And one forward. And here are those arrivals narrowed down to just deliveries to California ports, with Southern California claiming a strong majority of the volume. For California's R99 market, this import data gives us important context on some of those current events we touched on earlier. Imports to California alone averaged around 770,000 barrels per month from January to September of this year, according to those bills of lading. That's nearly 7.4 million barrels of RD into the California market this year, encouraged in part by the existing credit scheme. But the future of that delivery cadence is going to be a key discussion point when we talk about upcoming policy shifts. Namely, would this pace of deliveries be sustainable without the incentive of the BTC due to expire at the end of next month? We're already likely in the meantime to see a sharp reduction in volume from Singapore, represented here in the orange, because of Neste's October equipment failure coming back out of their scheduled turnaround. Singapore alone represents a monthly average of about 575,000 barrels of RD into the California market per month on average in 2024. Next. So we've covered offshore supply, and now we can zoom in a bit on the domestic production and flow of US-made RD. This chart shows estimated US RD production taken from the EPA's monthly domestic D4 RIN generation data. The latest data, released a few weeks ago, is for September, showing domestic output at around 3.8 million barrels, which would be the lowest in 2024 so far. We've otherwise averaged about 4.7 million barrels monthly this year. Next. So moving back into those Jones Act or domestic deliveries, as we talk about the flow of US-made RD, Kepler vessel data shows US Gulf Coast to West Coast deliveries at an average rate of about 620,000 barrels per month, going back to January of 2023. Contrary to our import trends, though, those Jones Act deliveries have actually trended slower in 2024, about 519,000 barrels per month so far. Most of those vessels are also destined for Southern California, where we hear from market participants that there is better access to pipeline infrastructure, whereas in Northern California, you have home to several RD refineries on its own. We see about 23% of Jones Act arrivals going to Northern California, and then just around 5% heading to the Pacific Northwest. Next. Where other movements from the US Gulf Coast are concerned, there are a few key export destinations, mostly in Europe. Again, we're referencing that Kepler vessel data, and we track around 1 million barrels per month on average for US Gulf Coast exports, although the rate of deliveries does fluctuate. Volume bound for Europe typically heads for the Netherlands, Norway, and the United Kingdom, among others. And we also see vessels transit to both Canada's east and west coasts, so that would be Montreal and Vancouver. So we've covered the flow of RD to the West Coast aboard vessels and via the local production, but our view of total supply would be incomplete without addressing the movement of RD by rail. This graph shows rail deliveries to Pad 5, which includes California, from other US districts. To put it simply, the West Coast receives railed RD from Pads 2, 3, and 4. Pad 3, the Gulf Coast, understandably makes up the largest share of that volume, typically followed by Pad 2, the Midwest, and Pad 4, the Rocky Mountains. About 1.8 million barrels have reached the West Coast by rail in September, which is the latest data we have from the EIA. And this is another arena where 2024 has brought record highs, the peak being May when Pad 5 received nearly 2 million barrels by rail. Lastly, for me, we've also got impending policy changes that are likely going to be key to RD strategy moving forward. So, when we talk about supply uncertainty, which is unfortunately most conversations you're having in today's spot R99 market, we're mainly talking about ever-changing federal and California policy, which are the key drivers of the growth we've seen in California's renewable diesel market over the last several years. It stands to alter the flow, production, and incentives for renewable diesel as we move into 2025 and beyond. There are a few things we're watching with a growing focus on carbon intensity underpinning much of what we're going to discuss here. I mentioned earlier the scheduled transition away from the BTC, which presently credits blenders $1 per gallon across biodiesel, renewable diesel, and sustainable aviation fuel. The BTC has been a key incentive for imports as a result, leaving the future of those flows a bit uncertain beyond the slated December 31st end date. The Inflation Reduction Act's 45Z Clean Fuel Production Credit is currently scheduled to follow the BTC beginning in January, tying the federal incentive instead to a fuel's carbon intensity, which can be claimed only by domestic producers and not blenders. The new credit should span through 2027, and fuels will be required to meet an initial carbon intensity threshold, from which point the subsidy will increase with further greenhouse gas emissions, and that credit will range up to $1 per US gallon for road fuels. 2025 should also bring new rulemaking from the EPA, which we learned was in progress back in September. The EPA should set new renewable fuels mandates for 2026 onward as we move into the next year. And in California specifically, the state's low carbon fuel standard, or LCFS, from this point forward, could see stricter CI targets and potentially limits on the credit generation potential for fuels produced using virgin vegetable oils. Implementation of the limits already proposed by California's Air Resources Board, or CARB, would give refiners more reason to rely on waste feedstocks and their lower resultant greenhouse gas emissions. Next. And a rough timeline of those changes is shown here. The soonest development could actually come this week, with CARB set to meet to consider those LCFS proposed changes in California. The end of December should bring the sunsetting of the BTC, as we discussed, with January ushering in the IRA's 45Z tax credit. But some of the 45Z's particulars are also pending clarification. Sometime within the next year, the USDA should finish rulemaking for climate smart agriculture, which could inform carbon intensity as pertaining to the 45Z. And that second darker arrow is what we're looking at now. The US Treasury is also supposed to clarify how carbon intensities will be calculated for different fuels and feedstocks, also pertaining to 45Z. Beyond the implementation of the IRA, the EPA is slated to propose those new RFS volume requirements for 2026 on, and in December of next year, we should see the finalizing of those requirements. All right, and now I'll hand it off to Andy.
Hey, apologies for that. A little trouble finding my unmute button this morning. Thanks again to Jasmine for her excellent work, and thanks again for everyone for being here this morning. So let's turn our attention away from the West Coast for just a second and talk about little bit more of a US wide view. If we could advance one slide, please. So, what we've seen in 2024, as Jasmine has talked in part about, is we've seen domestic capacity rapidly increasing. That chart on the right should look familiar to you. It's a chart that Jasmine showed a little bit earlier, but it drives that point home that we've seen significant increases in the last year or two in production. In 2024, we've seen logistics challenges, most notably some significant and costly delays along the Panama Canal earlier this year, and we've seen demand centers popping up outside the West Coast. As Jasmine mentioned, we're seeing exports from the Gulf Coast into both Canada and Europe. And recently, as many of you may have seen, New York City announced that they have transitioned their entire municipal fleet from petroleum diesel to renewable diesel. Their fleet of fire engines, buses, trucks, whatnot, which is a pretty large market and makes a New York Harbor assessment for Argus and for our client base much more interesting. So these factors have kind of combined to make the outlets for U.S. Gulf Coast renewable diesel production more diverse than ever. What was once a slam dunk to point shipments west once you've made them is now an ever evolving landscape. So, in response to those observations of our own and interest from our clients, we've developed two new assessments that I'd like to speak to for just a second. In early June, we launched assessments for FOB barges from the U.S. Gulf Coast and for delivered barges into New York Harbor. Until sufficient market liquidity exists in terms of bids, offers, and trades to have a real time market view, we've gone with calculated models. So let's take a look at the math if we could. Advance one. Slide, please. There we go. First, we'll take a look at the Gulf Coast assessment, which looks to identify the highest value outlet available to a local producer, which is typically sending production into California, and then the lowest value outlet available to them, which we've identified as delivering product into Texas for sale across truck racks to capture a state tax incentive there. Those two combine to form a range, if you will, of values for renewable diesel in the Gulf Coast. The math for the high value is our Argus HOP 99, R99 assessment that Jasmine mentioned, plus the value of LCF credits, assuming a UCO pathway, less the cost of marine freight from the Gulf to California. That is defined as the Argus Clean Tanker quote for NOLA to Louisiana, which has been running in the low 30-cent a gallon range for most of the year. Conversely, the low value is the way to look at it is that is the highest price a Texas diesel buyer will be willing to pay for renewable diesel in lieu of petroleum diesel. And we calculate that as the Argus 62 grade ULSD quote, waterborne quote, plus the state excise tax credit. Again, he's getting that credit, and so the ceiling is a bit higher than petroleum diesel. But then we subtract from that the incremental costs of moving, storing, and blending the renewable diesel. Based on market feedback, conversations with our clients, we've right now set that at approximately 10 cents a gallon, but that will be revisited periodically to make sure that it still stays in touch with kind of what the market looks like. And again, those now form the upper and lower end of what is our assessment range. The New York Harbor assessment is really just that Gulf Coast assessment plus marine freight from Houston to the New York Harbor. That again is the Argus Clean Tanker quote from Houston to New York Harbor, and that typically runs around 12 cents a gallon in recent months. So Argus prints these assessments as a low and a high and a mid for both outright prices and differentials to NYMEX ULSD. Now, it is worth noting that on occasion, the high value outlet can actually be below the low value outlet, which sounds a little counterintuitive. But how that would result is if LCFS credits became low in a hurry, if West Coast petroleum diesel spiked in California, if freight rates spike, you could end up with math where sending it to California is actually less advantageous to using it in Texas. If that happens, and it's rare, but it does happen, if that happens, then the lower of those two numbers becomes the low assessment, and the higher of those two numbers becomes our higher assessment. So we still keep with that market principle of the best value outlet to them would be the high, the lowest value outlet to them would be the low. Again, it's rare, but it has happened. So that runs through our Gulf Coast to New York Harbor assessments. And now I will turn it over to Leah for an update on Argus's forward view.
Thanks, Andy. Right. 2 more slides. All right. So quickly, hi, I'm Leah Kinnan. I lead the biofuels consulting practice for the Americas, so both North and South America at Argus. Today, I'm going to discuss the outlook of renewable diesel market in the US. Sorry, can you go back one slide? Doesn't look like that got in there. Okay.
Leo, would you like to share your screen if there's a slide that you have ready?
Can you go ahead 2 slides? Sorry, I'm just gonna see if yeah, okay. Sure, I can share my screen. Sorry about that. Give me one. Yeah, they're the same slides. you see my slides?
We can, yes.
Okay, great. All right, so you should be on a summary slide, yes?
Yes.
Okay, great. Sorry about that. All right. So quickly, so just key points for today. In the last 2 years, we've seen a fast adoption of renewable diesel into the low carbon fuel markets due to the incentive structure of these programs. So we expect this trend to continue and pull lower carbon feedstocks as the programs mature. With the implementation of the clean fuel production credit, as Jasmine mentioned, we will see a reduction in imports of finished renewable diesel, and we will see an increase of imports of waste-based feedstocks. With the delay of several renewable diesel projects and rationalization in the market, we will see a tight market towards the end of the decade. However, with little guidance from regulatory, we expect the credit price and thus the renewable diesel price to remain muted in 2025. For the US Gulf Coast production, the LCFS programs will continue to be the main driver, as well as exports to Europe for waste-based renewable diesel. In this slide, we are looking at the demand. We forecast the demand of renewable diesel to be predominantly in the states with low carbon fuel standard programs. Today, these include California, Oregon, Washington, British Columbia, and Canada, excluding British Columbia. We also assume some use of renewable diesel in the rest of the US that does not have LCFS programs currently. And when other LCFS programs will be introduced, the renewable diesel market will further tighten through the forecast period and beyond. Federal incentives will also continue to drive the use of renewable diesel. The EPA is currently developing blending requirements for 2026 and beyond, and we hope to see that guidance mid-2025. Overall, renewable diesel demand in North America will continue to increase through the forecast period. So renewable diesel demand across the US is expected to grow again with the federal and state programs. In Canada, you have the Clean Fuels Standard Program, and it will increase the consumption of renewable diesel in the country pretty significantly over the next decade. Canada, of all of the LCFS programs, has the largest transportation diesel pool and will eventually command a significant portion of their renewable diesel. As you can see, out 2030, it almost meets the same amount as California. Today, renewable diesel makes up 70% of the total diesel pool in California, and due to the significant penetration of renewable diesel and a shift to electrification, the California demand does stabilize after next year in our forecast, but it will continue to be the most advanced renewable diesel market among the current LCFS programs. Currently, proposed capacity additions won't be enough to satisfy demand across the states with current or emerging LCFS programs. And again, future LCFS programs in other states will likely drive faster renewable diesel penetration than current states, as decarbonization schedules might be tighter to catch up with the broader GHG goals of the existing LCFS programs. Okay, to the next slide. All right. So why do we forecast the demand off of the few states in the previous slide? So these states and the provinces in Canada are in the dark blue. These states have active LCFS programs, and just a quick overview. So low carbon fuel standard programs require yearly reductions in transportation fuel carbon intensity. So higher carbon fuels that exceed annual limits incur deficits that suppliers must offset with credits generated from the distribution to the market of approved lower carbon alternatives. Because of the incentive to use lower carbon fuels, the products typically flow to these states or provinces. In the case of Canada, again, if more programs were to be introduced, the market could quickly find itself in a net short position, which we'll go over shortly. There are states that are currently considering LCFS programs. You can see these in the dark gray. New Mexico recently passed an LCFS program, and it's likely to take effect mid-2025, but could be delayed to 2026. And then the light gray states are states that have not had any action on LCFS programs. The gray states make up roughly 61% of gasoline and diesel demand in the US. All right, so what does this mean from a feedstock perspective? Much of the growth in biofuel demand is expected to come from conventional waste feedstocks, as growing adoption of carbon intensity-based credit programs in the US favors biofuels from low carbon waste feedstocks. These receive more credits per US gallon than, say, crop-based renewable diesel. But starting in 2025, the flat dollar per gallon BTC or blender's tax credit becomes a producer's tax credit based on emissions factors. This will benefit producers that have access to pre-treatment capabilities that can process waste-based feeds with lower CI. You can see in the trend on the left that while crop-based feeds continue to grow, the pace at which waste grows is much greater. So if we look at the demand for UCO, it is forecasted to increase almost 9.2 million tons by 2030. California is expected to be the main destination for this product, but we also envision rising UCO demand elsewhere in North America. In August of this year, our CARB put forward a proposal that would limit annual credit generation from soybean and canola oil and sunflower oil. It would cap that at 20%. Companies that already have certified pathways, which are exceeding the proposed cap, have until 2028 to adjust supply before facing limited credit generation, and all other companies have to comply with that cap by April of 2025. As total credit generation from these feedstocks has not yet reached 20% in California, we don't foresee changing. And given the large and rising share of waste-based product, we don't expect the proposal to have significant impact on our forecast should that proposal go forward. But overall, we expect soybean oil demand to continue to increase in North America, owing to the growing demand for renewable diesel outside of California in places as Washington, Oregon, British Columbia, and the rest of Canada. Soybean oil is expected to still grow to 9.4 by 9.4 million tons next year. That was right. All right. Go forward. All right, so if we look at kind of a more global supply or trade flow balance, the US imports of renewable diesel has risen steadily over this year, in part from rising demand, but also as producers and blenders look to complete blending activities. I believe Jasmine mentioned this, before the financial incentives of the BTC expires at the end of this year. So starting from 2025, renewable diesel blenders and producers outside the US will no longer receive the dollar per gallon credit, and this will lead to a drop in import volume starting next year. The UK has restarted importing from the US this year as renewable diesel demand in the region has increased, making it the second biggest importer of US produced renewable diesel. Asia has a renewable diesel capacity of 3.4 million tons a year, but it has very limited demand. There are very few regulatory drivers in the region. So we forecast this surplus to continue for the next decade and therefore expect exports to continue out of Asia. EU anti-dumping duties on China origin biofuel may also slow the flow to Europe, and China makes up 58% of that capacity in diesel. So just wanted to share with you the map of the different production units of renewable diesel in North America. There's a significant amount of capacity concentrated in the US Gulf Coast, but you can also see that capacity is located close to feedstock sourcing. So in your kind of Midwest states in the central part of the US. And then finally in California and West Coast is those where the demand centers are located. As you'll see in the next slide, there's a significant amount of capacity that is still provisional. So we can go to that now. Okay. All right, so the initial years from 2020 to 2023 in this chart are characterized by minimal new capacity additions, focusing on planning, internal assessments, and optimizing current operations. In 2024, we saw a significant jump in renewable diesel capacity, leading toward a slight overbuild. This overbuild could last until about 2027. However, this view does not consider operating rates and future rationalizations of capacity. So as you can see, without the very provisional capacity coming online, we will see a net short position by 2027. Looking at the various pathways to renewable diesel, there are a few technologies represented in this supply view. HEFA, or hydrotreated esters and fatty acids technology, currently accounts for most of the operating production capacity given its technological maturity and commercial scalability. Similarly, the majority of planned firm projects in the short term are HEFA plants. HEFA production pathways have several advantages over its alternatives: higher production yield, feedstock availability and flexibility, low CapEx and OpEx requirements in comparison to the other pathways, and then relatively easy to reconfigure existing refineries. So then the other one is alcohol to jet and gasification pathways. This is expected to account for an increasing share of the planned production as the CapEx and OpEx requirements decrease over time with scalability. So in addition, both technologies can process non-edible woody biomass and agricultural residues to manufacture biofuels. These cellulosic fuels products can meet increasingly stringent fuel specifications in most markets, notably Europe. And then despite the last one would be power to liquids. So despite power to liquids pathway as the most favorable from a GHG reduction, there are only 3 very provisional PTL plants in North America today. Go slide. So to further a possible significant shortage in the market, we expect the total project time to full production of renewable diesel plant is 5 to 6 years. So front end loading is expected to take about 18 months, construction anywhere from 2 to 4 years, commissioning 1 to 2 years, and start up to full capacity another 1 to 2 years. So given that timeline, if a significant portion of the very provisional that I showed previously, if that does not reach FID by the end of 2025, we will likely be considerably short by the end of the decade. All right, next slide. So this shows our supply demand global balance each year. So the years you see in those bar charts are 24, 25, 30, and 35. So in North America, there have been delays to upcoming plants from 2024 to later years, and that has muted a bit the 2024 length. And then next year, we expect demand in North America to continue to be driven by the LCFS programs, California, Canada, and other US states. While California has taken steps to make stricter targets by 2030, recent Canadian guidance has actually lowered our expectations of renewable diesel deficit in the region by 2035. We look at Latin America. There are currently 4 plants operating in Latin America, 2 of which are co-processing units. So they are also making hydrocarbons at the same time. We expect 4 additional plants to come online in the coming years. Brazil recently announced a 3% renewable diesel mandate starting in 2030 as part of its Fuels of the Future package. But until this mandate kicks in, we expect some consumption will continue from Petrobras, which offers its co-processed product to the domestic Brazilian market. In Europe, you'll notice that it's net short through the forecast period. We anticipate it to remain in deficit for renewable diesel. Construction of Shell's 820,000 tons a year SAF and renewable diesel plant remains halted, and we expect trade or additional capacity will continue to be needed to meet the regional demand in the long run. If we look at Asia again, right, there's not a regulatory driver for demand, so a surplus of renewable diesel is forecast in Asia Pacific until 2035. Although many of the countries in Asia have looked towards sustainable aviation mandates, most have yet to announce proposals to mandate renewable diesel use. So South Korea is really the only nation in the region that has a direct mandate for renewable diesel, and it is set at 3% by 2030. Although some consumption has been reported in Indonesia and Malaysia, we expect similar low consumption to continue through our forecast period. That is what I have prepared today. I think that is it.
All right. Thank you very much. Appreciate that, Leah. Also, Jasmine and Andy. At this time, we're going to go ahead and take some questions. We did have a few submitted. If you do have any additional questions, feel free to put those into the chat and we'll address them if we can. First question is from Jenny. Do you see USGC export to EU volumes adjusting to the potential loss of import volume in 2025 to meet US regional demand?
Jasmine, you want me to take that?
I can begin to answer that.
Okay.
Just so based on some of the conversations we're having in the market, I do think that that is one option as we look at sort of a post BTC supply flow. With the loss of or the sharp reduction of a lot of the imports to California, there is the idea that some of that West Coast, that Gulf Coast product will further make its way to the West Coast. Although whether that's by Jones Act or if we're going to see, more rail deliveries to the West Coast, I think remains a question and the magnitude of that shift. But I think that is one sort of school of thought that's floating around in the California market conversation, at least. And then Leah, I don't know if you have something further to add.
Yeah, so I think that, CARB is voting on their new proposals on Friday. So we'll know a lot more about how those targets look for next year. But I agree with Jasmine. I believe that the flows from the Gulf Coast, especially those lower CI pathways, so the waste-based feedstocks, those are going to find themselves in California much sooner than probably in Europe with the expiring of the BTC.
All right. Our next question, how will California's LCFS program proposals affect demand of renewable diesel going forward?
Yeah, so I noted this a bit in one of the slides, but California's LCFS program will continue to be more and more stringent. Again, if the proposals are passed, so what you'll likely see again is the low carbon fuels, the low CI pathways flow to flow to California, and then the remainder would flow to, say, Washington, Oregon, and different parts of Canada. I think that what will end up happening towards what we showed in the end of the forecast period is California will drive more towards electrification of their fleets, both even in the mid and heavy, and that is the goal. So you'll see kind of a tapering off of total renewable diesel demand as kind of the total fuel pool for traditional liquid fuels gets smaller.
All right. A question from Ted. With the expiration of the BTC and change to PTC and the expected growth of RD, what expectations do you have on BD blending on the WC and US overall?
So I could take a first stab at that. I would say you've already seen a little bit of market reaction to that in recent months with the closure of a handful of biodiesel plants around the country. I think a longer term, more final answer will come with clarity on what CI values and tax credit values with the CFPC actually look like, to see how advantaged renewable diesel is versus biodiesel. So I think there's more to come there, but I think you've already seen the market kind of move in the direction it's predicting, which is that renewable diesel will fare better than biodiesel.
Yeah, and one thing to add on that is the CFPC actually favors the low carbon feedstocks into sustainable aviation fuel more than anything. So we're probably going to see the pull of those low carbon feedstocks that could be used for biodiesel end up in SAF instead. And then you'll end up having a situation where some of those biodiesel pathways don't meet some of the more stringent LCFS programs, so they won't be credit generators.
All right. We have another question from Caitlin. With the recent push from U.S. lawmakers to limit credit generation eligibility to domestic feedstocks only, is there a concern over feedstock availability in the U.S. if imported feedstocks are excluded?
So I'll take a stab at that one. So feedstock availability. So I think that the US has a decent supply of veg oils. I think the challenge that you would see if we only provide that producer's tax credit for domestic feedstocks is it will be misaligned with some of those low carbon fuel standard programs. So you'll have an issue where you would more or less back out some of your waste-based feeds. So say tallow from South America and UCO from Asia. And then you could see a situation where you struggle to meet a lot of those low carbon fuel standard restrictions or reductions in CI going forward. Honestly, we've talked about this a lot internally, and we don't think that that is likely because you have kind of two opposing views. You know, California trying to limit veg oils, and then you have some people trying to limit waste-based feeds coming into the U.S. So it would be a very challenging market if both of those were to go through.
All right, I think just one last question at this point. Due to low credit pricing, there have been several delays in projects and even reduction in capacity. What are your views on credit markets next year?
Jasmine, Andy, do you want to take a stab? I'm happy to answer.
Well, I can kick it off, and then Leah, you can pick it up again. I think it's a bit of a similar answer to what I gave before, that it's going to require more clarity on the CFPC to truly understand what next year is going to look like. Leah, I don't know how you'd like to add to that.
Yeah, so our view from a forecasting standpoint is we believe that with the expiring of the BTC that we'll actually see a somewhat increase in the D4 RIN in order to kind of make up some of that marginal producer economics. For California, again, we think that if those proposals are to be passed, it's a pretty significant jump in the reduction targets. So we would see that the LCFS market, the prices could increase, but likely not until you have, 1 or 2 quarters of credit publications, right? So once we see that the credit generation decreases, you see kind of the balance coming down from a net credit standpoint, you could see the LCFS credits continue to increase.
All right. It looks like we've covered all of our questions. Leah, Jasmine, Andy, do you have anything else you want to cover before we wrap up?
Just a thank you for me and everybody on the Argus editorial side, for everybody that tuned in today. We appreciate you listening to us for the past hour, and hope that we added something to your knowledge base on renewable diesel.
Thank you.
All right. Well, thank you, everyone. We appreciate you being here. And as mentioned at the beginning, we will distribute a rebroadcast link for the webinar in the next couple of days, as well as a PDF of the presentation slides. In the meantime, if you do have any questions, don't hesitate to reach out to myself or any of the panelists. Thanks again for joining us, and we will see you next time.
Thank you.
Thanks, you guys.